Welcome to the deep dive. It feels a bit like standing on seemingly solid ground, but sensing these deep rumbles underneath.
That's a good way to put it.
That's kind of the paradox we're diving into today. This surprising, almost unnerving calm in global markets.
Yeah, despite some major geopolitical tremors.
Exactly. We're talking about the recent U.S. airstrikes on Iranian nuclear facilities, Natanz and Fordo. Big news.
Definitely.
You'd expect, well, chaos, right? Markets tumbling. But instead, it's quiet. Too quiet, maybe.
It does feel that way, a bit counterintuitive.
So today we're going to try and unravel this complex web, look at the financial reactions from oil prices right down to a specific stock market.
And our mission really is to help you connect those dots. See how international conflict ripples out, directly and indirectly, especially hitting regional economies.
We've got the latest market briefings, some revised forecast models, and we're really going to focus on Sri Lanka.
Ah, yes, Sri Lanka.
Because it seems to just perfectly capture that fragility, how these big global events can hammer vulnerable economies even while the broader markets seem, well, calm.
It's a stark contrast, isn't it? And a crucial lens, I think. This isn't just headlines. It's about seeing that real-world economic vulnerability up close.
Okay, so let's jump right into the spark. The breaking development. U.S. airstrikes confirmed on Ananans and Fordo.
Confirmed by the Pentagon, yeah.
This feels different. It's not proxy stuff anymore, is it? This is direct.
Absolutely. It's a major escalation. We've moved from proxy engagements to direct military action between the U.S. and Iran.
And the whole world is watching Iran now. What's the next move?
Exactly. And we're already seeing those subtle economic effects start to ripple out, often where you least expect them.
Which brings us to something I find genuinely puzzling, this oil paradox.
Right.
Brent crude, as of June 22nd, 2025, trading around $77 a barrel. 77. After these kinds of strikes.
Lower than last week, even.
Lower. You'd expect a huge spike. Maybe not full crisis mode instantly, but something. What on earth is going on?
It is remarkably strange on the surface. The market's rationale right now seems to boil down to a couple of things.
Okay.
One, the sheer strength of U.S. oil production. It's robust.
Yeah.
And two, Iran's actual share of global oil supply right now isn't that dominant.
No. So the thinking is there's enough global supply to kind of cushion the blow?
That seems to be the prevailing sentiment, yeah, that the market can absorb an immediate disruption from Iran itself without, a massive price shock.
But there's a catch. There has to be.
There's a huge catch. This $77 oil, it's all completely contingent on one thing: stability of the Strait of Hormuz.
The choke point. Okay, for anyone listening who isn't familiar, spell out why Hormuz is the real sort of ticking time bomb here.
It's everything. It's the world's single most critical oil transit choke point. Period.
How much oil actually goes through there?
About 20% of the entire global oil supply. A fifth of everything traded moves through that narrow strait every single day.
20%. Wow.
So if Iran disrupts that passage, even threatens it credibly, you're not talking about $77 oil anymore.
No. What are we talking?
You could see Brent jump dramatically. Maybe $110, $120 a barrel. Potentially overnight.
Overnight? Okay.
And that is precisely where Sri Lanka's vulnerability becomes so incredibly stark.
Right. So connect that directly for us. Why is Sri Lanka so uniquely exposed to these oil price swings?
Well, first and foremost, Sri Lanka imports 100% of its fuel.
Yeah.
Every single drop.
100%. Okay.
So there's no domestic buffer. Any rise in global prices is an immediate direct hit to their balance of payments, to their entire economy.
Give us a sense of scale. What does a price hike mean in dollar terms?
Okay, consider this. Just a $20 per barrel increase in oil prices. That adds over $600 million a year to Sri Lanka's import bill.
$600 million. And how does that compare to their reserves?
That's the killer. That $600 million is more than a third of their entire usable foreign currency reserves.
A third gone just from a $20 oil hike.
It would drain them incredibly fast, blow the trade deficit wide open.
Yeah.
And that's just one part of what we're calling Sri Lanka's triple shock.
Triple shock. Okay, so it's not just the oil import cost then. What else?
Exactly. It's multifaceted. Second, think about remittances.
Money sent home by Sri Lankans working abroad.
Precisely. Millions work in the Middle East, especially the Gulf states.
Yeah.
Those remittances are a vital source of foreign currency.
Okay.
If this conflict escalates and regional economies in the Gulf slow down, or if workers feel unsafe, those crucial inflows could dry up. Or at least diminish significantly.
Right, less money coming in. What's the third shock?
Tea exports.
Tea? Really?
Yes. The Middle East countries like Iran itself, the UAE, Saudi Arabia, They are major buyers of Sri Lankan tea. It's a key export.
Huh. I didn't realize the connection was that strong.
It is. So if trade routes are disrupted, or if demand falls in those markets
Hmm.
because of the conflict, that's another hit to Sri Lanka's export earnings.
So you've got higher import costs from oil, potentially lower export earnings from tea, and potentially falling remittances.
That's the triple threat.
Hmm.
Higher imports, lower exports, declining inflows, all potentially hitting at the same time. It's a perfect storm brewing.
A truly precarious position, and
Yeah.
yet we look at their stock market, the Colombo Stock Exchange, the ASPI. It closed June 20th at 17,087.
Holding steady on the surface.
Yeah, relatively steady. Is that just resilience? Or is something else going on underneath? Are we missing something?
Well, it's definitely not signaling outright panic yet, but you're right to question the surface stability. If you look closer, there are um, definite signs of stress.
Like what?
We're seeing narrowing market breadth. That means fewer stocks are actually driving the index level. The gains aren't widespread. That's often a sign of underlying weakness.
Okay. What else?
Foreign investors are pulling back. They pulled out 78 million rupees just last week. Not a huge amount in global terms, but significant for Colombo.
So foreign money is getting nervous.
Seems like it. And we're also seeing increased demand for defensive stocks.
Ah, the safe havens, energy, utilities.
Exactly. The kind of companies investors tend to buy when they're worried about broader economic turmoil. And maybe most importantly, liquidity is tightening.
Meaning it's harder to trade?
Harder to buy or sell large amounts without moving the price significantly.
Mhm.
It suggests caution, maybe nervousness among the big players. So yeah, it's a very, very delicate balance right now.
Okay, so keeping that delicate balance in mind, and with Brent still, below $80 for now, let's look at the numbers. You mentioned revised ASPI forecast models. What do they actually show? How could different scenarios play out?
Right. So the model gives us a range based on different escalation levels. Let's start with a base case. If oil stays around this current $77 level, the ASPI might hover immediately between 16,900 and 17,300.
Okay, pretty close to where it is.
Yeah. Then maybe drifting up towards 17,500 to 17,800 in the next 1 to 3 months, and perhaps hitting 18,000 within 6 to 12 months. That's if things stay relatively calm.
But what about limited conflict, which is sort of where we are now, arguably?
In that scenario, the immediate forecast dips a bit lower, 16,200, 16,800. Then a slow climb, maybe 16,800 to 17,200 in 1 to 3 months, and potentially 17,500 longer term. So lower overall.
Okay, now, the big one, the Strait of Hormuz closure. That nightmare scenario.
If that happens, the model suggests an immediate sharp drop. We're talking 14,800 to 15,600.
Wow, that's a significant fall from 17,000.
It is. And recovery would be slow, maybe crawling back to 15,200 and 16,000 in the short term, and perhaps 16,500 in 6 to 12 months. A serious hit.
And the current stage, this U.S.-Iran war escalation?
That's actually modeled slightly worse for the immediate impact than just Hormuz closure, interestingly. Immediate drop to 13,900, 14,800.
Even lower, why?
Perhaps reflecting broader regional instability and fear, not just the oil choke point. The model suggests a slow recovery then to maybe 14,500, 15,500 short term, and 15,800 long term. Still well below current levels.
And what's the absolute worst case in the model?
The model includes a scenario for tactical nuclear use. Obviously, highly unlikely, we hope.
But it's modeled. What does it show?
An immediate plunge,
Right.
down to 11,300 to 13,000. Recovery would be incredibly slow and painful, maybe back to 12,000, 14,000 short term, perhaps 14,500 over a year. Just catastrophic.
That's sobering. But is there any upside scenario?
Yes, absolutely. A ceasefire scenario. De-escalation. That provides substantial upside.
What kind of numbers?
Immediately, the ASPI could jump to 17,900, 18,200. And within 6 to 12 months, potentially hitting a high of 19,000.
So a huge potential swing depending on which way this goes.
A massive range of possibilities, yeah. It really highlights the volatility hanging over the market.
It really does. Which brings us back to that fascinating question. Given these potential scenarios, especially the downside risks, why aren't global markets freaking out more right now? Is it just complacency?
I don't think it's pure complacency. It's more like market fatigue, what we often call geopolitical desensitization.
Desensitization. Meaning investors have just seen too much noise.
Exactly. Skirmishes, threats, regional conflicts,
Yeah.
they happen relatively often. So they're really big global investors, the ones moving the major markets. They tend to only react with real panic when something looks like it's about to break the fundamental plumbing of the global financial system.
Something truly systemic.
Right. Until that point, a lot of this gets priced in as background noise. But, and this is the key insight, I think while the big global markets can kind of absorb these initial tremors,
A frontier market like Sri Lanka can't?
precisely, they don't have the deep capital buffers, their economies aren't as diversified, they feel these tremors immediately and much more acutely.
So Sri Lanka isn't just a canary in the coal mine.
It's arguably the canary right now. It's the market's early warning system. It shows us the real localized fragility that could spread outwards if these tensions escalate further.
That's a really powerful way to think about it. Okay, so given this fragility, this canary status, what is the path to upside for Sri Lanka specifically? What could turn this difficult situation around?
Realistically, the only clear path to significant sustained upside right now is a definitive ceasefire, or at least a major credible de-escalation of the conflict.
Something brokered, maybe? UN, China?
Ideally, yes, something that convinces the markets the worst-case scenarios are off the table. That would likely push oil back below $75, maybe even lower.
Which would ease the pressure.
Exactly. It would calm commodity markets generally, ease Sri Lanka's import burden, boost confidence, and support that ASPI recovery towards the higher end of our forecast, maybe 18,700 to 19,000.
But without that de-escalation, the immediate danger is still very real.
Oh, absolutely. Sri Lanka is squarely in the red zone, as we put it.
Mhm.
If Iran does make a move on Hormuz, or if it targets Gulf allies directly, that ASPI could break down hard towards that 14,800 level, potentially quite quickly. Weeks, maybe.
It really is walking a tightrope then.
Incredibly delicate, yes.
So to sum up, the ASPA might look stable around 17,000. Brent might be hovering at $77. But underneath, with these war clouds gathering, it's anything but stable.
The tightrope analogy is perfect. And Sri Lanka's right there, showing us just how thin that rope is, acting as that canary.
What really strikes me is just how fast that stable appearance could shatter. It's a potent reminder of how interconnected everything is, global events, local economies.
And how vulnerable even seemingly stable situations can be to these geopolitical pressures. It definitely sharpens the focus on systemic risk.
It really does. It makes you think, doesn't it? How do we understand and prepare for these kinds of shocks in the future? Let's just hope diplomacy can win out before oil prices do.